Good evening, everyone. A very warm welcome to the fourth Income Tax Symposium, March 2026, organized by Educating and Tax Connect. I would now like to introduce our speakers, Mr. Vivek Jalan and Mr. Rohit Sharma. Mr. Vivek Jalan is a qualified CA, MBA, qualified LLM, and LLB. He is the partner of Tax Connect Advisory Services LLP. He is a regular speaker at various professional forums, specializing in both direct and indirect taxes. Mr. Rohit Sharma is a qualified advocate. He is currently serving as a joint partner at Tax Connect. He has rich experience of more than 15 years in indirect and direct taxes in India. Also, we have Ms. Pooja Garg from Edukating, who is a qualified CA and co-founder of Edukating. She is also moderator of the session. During the session, please put your video and microphone off. If anyone has any query, please feel free to write it in the chat box. We will address all queries at the end of the session. Now, we request Pooja ma'am from Educating to say a few words. Over to you, Pooja ma'am.
Good evening, everyone, and wish you all a very happy Ram Navami. May this auspicious occasion bring positivity, peace, and success to all of you. Thank you so much, Mani, for the warm introduction. I'm really happy to be here with all of you today. This symposium is a collective effort by Tax Connect and Educating. Through this series, our aim is to bring practical insights and real-time updates in taxation so that professional like all of us can stay updated and be better prepared. Just to share a quick note about Educating. Educating is an online knowledge sharing and consulting platform focused on e-learning, corporate training, and professional consultancy in taxation and finance. Our sessions are designed by the experienced professionals with a strong focus on practical exposure and industry relevance. We try to keep everything as real and based as possible so that learning is actually useful in practice. I would also like to thank the Tax Connect team for collaborating with us and making this session happen. With that, I would now like to hand over the session to our first speaker, CA Vivek Jalanji. Looking forward to a very insightful discussion. Thank you.
Thank you, Pooja, and thank you, Mani. Thank you to all the participants for joining on this Friday evening. And as we stand at this juncture, where from 1st of April 2026, the entire Income Tax Act would be changed and we would go into a completely new regime in income tax. So this symposium, I think this is the fourth symposium on income tax, which we from Tax Connect, partnering with Educating, are holding. And we would continue to hold these monthly symposiums. The endeavor is to share the knowledge and to also discuss and learn from each other as the new Income Tax Act 2025 and Income Tax Rules 2026 unfold. And as India move forwards into a completely new taxation regime, while this Income Tax Act 2025 and Income Tax Rules 26 are drafted with the objective of simplicity, but we all know that the ultimate objective of every tax law is to collect taxes. And therefore, in this endeavor, there are bound to be certain new interpretations which will arise. And of course, jurisprudence was also developed over the years in this new Income Tax Act 2025. we from Tax Connect are thankful to Educating to starting this symposiums over the last 3-4 months. And as we unfold this Income Tax Act 25 implementation journey, we would endeavor to continue with this monthly symposiums on Income Tax Act so we can share the knowledge and also learn from each other, all the taxpayers and trade and industry at large. And also thankful to Pooja from Educating for accepting to moderate the session, and my co-speaker Rohit, who would also deliberate on few of the topics which we have already circulated, which we'll discuss in this webinar. So I'll share my PPT. Is the PPT visible?
Yes, sir, it is visible, but text is very small.
Yeah. Yeah. So uh, we'll discuss on the various topics, on 31st March, do's and don'ts. This 31st March will be different. We'll discuss why for the income tax taxpayers in the light of the new Income Tax Act implementation, we'll have to do as taxpayers, as accounts and finance and taxation department, and be careful of a lot more things on this 31st March 2026. We'll also discuss on the changes from 1st April 2026 and on the TDS and TCS part, because that would be the first thing which would be highly impacted with the implementation of new Income Tax Act 25. Transitional provisions, that is the repeal and saving provisions. 143.1, we will discuss the intricacies of 143.1 in the light of various cases which we have handled before the CIT Appeals Adjudicating Authority and the Income Tax Appellate Tribunal. What are the things you must do and what are the things which you must not do after receiving a 143.1? Generally, we think filing of 154 is the best thing to do after receiving 143.1. Well, we will discuss on that and what other things which you should do. TDS on year-end provisions, 31st March. A query is always that whether TDS is liable to be deducted on provisions or not. We'll discuss on that and on the judicial precedents. Employee salary under the new Income Tax Act and specifically the changes in the new income tax rules 2026. What are deductible, non-deductible expenses? And in the light of this, we have all heard on the survey on the restaurants, what are fake expenses and what can be added, what cannot be added as fake expenses or undeductible expenses or purchases. We'll discuss on how you can contest the penalties under the appellate proceedings as well as adjudication proceedings in the new as well as old Income Tax Act and other important developments. So a host of topics to be discussed over here. Let's get started with the first and the hot topic of March 2026. We have all seen and read in the media the Income Tax Department search and survey on the restaurants. Well, this is the press release before you on the screen. I hope the press release is visible on the screen. Uh, so around 1,77,000 restaurants across India, they were scrutinized as far as their transactional data is concerned, and around 63,000 restaurants have been identified. Many have been surveyed or searched also as per this press release. And it has been found that there is a susceptible evasion of more than 400 crores already, and much more is in store. And therefore, this, as per this press release in March 2026, the Income Tax Department has nudged all the restaurants to file updated income tax returns, right? So, all the updated income tax returns, we'll discuss further on this on March 2026, the preparations, etc. By this press release, the Income Tax Department has nudged. They have started a new nudge. We have seen an old nudge in the last 2 years in December for the taxpayers who have any foreign assets or foreign income. There was a nudge campaign to propel these taxpayers to disclose their foreign assets and foreign income and pay taxes on the offered the foreign income which was not offered for tax. Now they have started a saksham nudge to these restaurants that in case there is any unreported sales, unreported income, they should file an updated income tax return so as to escape from penalty, etc., etc. So, friends, what are the issues? We'll discuss why we are discussing these. Is that what we understand? As the new Income Tax Act unfolds in India, the tax departments would have a lot of data. They already have a lot of data, but if you see the new forms, the tax audit reports, etc. The new income tax returns have not been released. They will be released going forward. But other forms also, including, forms as simple as the salary declaration forms, 26 as the new 26 as, which is the new form 168, etc. So they will have a humongous amount of data, and therefore a great focus area would be B2C trade, right? Somehow it is felt that in B2C trade, where the businesses are directly selling to the consumers, that is a very risky trade, right? And it is prone for evasion. So, what are the issues? We'll discuss on this restaurant case, and going forward how B2C trade they should conduct themselves, and what all issues they should keep in mind while filing their income tax returns and making their accounts so as to not get the wrath of the income tax department. Mind that if income tax department scrutinizes you or finds an evasion, be rest assured that GST will follow. So, what were the issues? The issues here were uh, detection that bulk deletion of the bills were made. See what happens in B2C trade. Generally, the traders or the MSMEs, I would say SMEs, basically the micro organization and the small scale organization where turnover is somewhere between 1 crore to say around 50 crores or 100 crores also, who are doing B2C trade, they generally feel that okay, they also try to manage the turnover, and sometimes in that race there is a bulk deletion of the sales bills right from the point of sale systems or etc. So this was found in this restaurant search and survey also. Sometimes the value of the bill is modified also. So one of the taxpayers who was dealing even with vehicles trade, but he was dealing with the consumers. So in that case, somehow one of the accountants we saw, he was changing the value of the tax invoice also, because under GST it was not mandatory to issue e-invoices for B2C trade. So sometimes the value of the tax invoice, that is also changed, and the reporting happens on undervalued invoices. This was found in the case of these restaurants also. Transactions which are completely not reflected, right? It is directly cash to cash. It is a cash economy, like banquet bills. A party happens in a restaurant, a banquet event happens, etc., and the entire transactions are in cash and therefore not reflected. Fake purchase bills were found. Aggregator sales were not fully recorded. Now, this you see now, cloud kitchen is very in vogue, specifically in the southern states, in Bangalore, Hyderabad, etc., where there is a lot of Cosmo crowd. And these cloud kitchens, few of the cloud kitchens, they come to us and they say that they have not recorded the sales which they also completely make through aggregators. So that was also found out here. Maybe cloud kitchen, maybe sales through Swiggy, etc. Ignoring the TDS TCS data, which reflects in your Form 26 even GST TDS or TCS, it reflects on your GST data and income tax Form 26 AS, etc. And you do not offer the entire amount for taxation on which TDS has been deducted. Now, for the small manufacturers, sometimes their electric consumption, energy consumption, and such other data that does not synchronize. For we once we audited the mines, right? Generally, in the mines, electricity consumption has to be in sync with the output which is generated from the mines, right? So also for the manufacturing units, etc. So if this data, this is not in sync, your electricity consumption is much more and your sales is much less. So even this falls within the survey and the ambit of the income tax scrutiny. And there are certain sectors which are GST exempt, right? And they somehow they miss out on reporting the complete sales, like petrol pumps, etc. So all of these fall under the sensitive data, sensitive sectors for the income tax department. And this restaurant survey, this possibly sets the way for a sector-wise scrutiny now across the country. So, which sectors should be further? They should be aware, and they should now try to sanitize their accounts and maintain correct books of accounts going forward. Restaurant, cafes, bars, we have discussed. Hotels, event management companies, hospitality sector. This is a very sensitive sector as far as income tax is concerned. Retail and trading business, shops in the malls, standalone shops like cloth shops, etc. Many of them, electronic shops, electrical shops, even kirana stores, certain kirana stores. Some kirana stores we have seen, they do business of more than 15-20 crores in a year, or even more than that. So all of these retail and trading business, they need to further streamline their books. Small real estate developers who develop standalone buildings, of course, the bigger real estate sector, that is always in the scrutiny, because real estate historically is, you know, privy to the income tax scrutiny. Supply chain of real estate, the cement distributors, the cement company, the cement shops, etc., the shops involved with the steel supply to the real estate sector, the interior decor shops, etc. Sellers of vehicles in B2C trade, jewelry and bullion, transport and logistics, completely unorganized sector, entertainment and influencer economy, content creators, freelancers. Some of these content creators and freelancers, their income goes beyond, crores. And, even if books of accounts are not maintained, then they can go into the simplified uh, 44 AD, ADA regime, etc. Small scale manufacturers who are doing turnover of 10 to 50 crores or 100 crores, the input output ratio is very important, and it is in the departmental eye always. E-commerce online sellers, sometimes they forget to report the sales in the ITR mines. So all of these sectors, they in our view, they should, looking at these restaurants and other these kind of surveys which have started, they should streamline their processes, etc., also, so as to keep in line with the law. recently we have seen in the, I think 3 months back, the Karnataka SGST department, they have sent bulk notices to even, the street vendors, because they were taking a lot of money from the customers through UPI and banking channels. And some of their turnovers crossed more than 1-2 crores, and they were not offering it for taxation under GST. Mind that GST is one part, and immediately income tax will follow. So B2C trade, I think many of these income tax searches and surveys, they originate from those notices which was sent by the Karnataka GST departments also. So, what do you do as these in these sectors to streamline your books? Check your place, the point of sale system, and ensure that the entire billing travels to your accounts and tax filings. Be careful about the Swiggy, Zomato, etc. online sales which you are doing through aggregators. Input output ratio is very, very important for manufacturers. Now, stock taking. I think this is 31st March, and we would discuss on the other points of action on 31st March. But I think the traders, the manufacturers, etc., the small scale and medium scale ones, they should start a year-end stock taking if you are not doing it now, right? Because from the stock taking, your sales and purchase gets streamlined. You can calculate your sales, approximate sales, how the department will calculate going forward in opening stock plus purchases minus closing stock. So I think stock taking is a very, very important part in the MSME sector, which sometimes the MSME sector, they miss out on. uh you should closely monitor on the, in case you are reporting cash expenses, etc., and you should have the backup, for those expenses. Mind that for any inflated expenses, the income tax has all the data. Track your investments and spends in SFT transactions. So the SFT transactions which are in section 285 BA, we'll discuss on them. If somebody else is reporting to you, you're going to a hotel and spending more than 1 lakh rupees, or you are spending in cash for purchasing goods or services more than 2 lakh rupees, somebody else is reporting that transaction. So beware of this. Investment spends, ensure all your investments are accounted, and we always suggest to the MSMEs, even to the individual taxpayers who are proprietors, etc., please make your balance sheet, even personal balance sheet. That is very, very important. From that you can see whether you are in cash negative or not. So with this new income tax act coming to picture from 1st April 2026, all these, basics of accounting are very, very important. One very important development in the new Income Tax Act 2025, which you must be aware from 1st April 2026, we'll discuss on others, is that earlier uh, your 10 lakh plus cash deposit in a bank account, that was an SFT transaction, it was tracked. Now, per account, if you withdraw more than 10 lakh rupees of cash, that will have to be reported by the banks also. So if you are withdrawing cash from the banks more than 10 lakh rupees, then be very, very uh, accurate with maintaining the records of those cash withdrawals, right? This is very, very important, friends. This is a new SFT transaction in the new Income Tax Act 2025, which will be in the radar of the Income Tax Department. And over 26-27, I think one very important to do is to track those bank accounts where you are withdrawing more than 10 lakh rupees of cash for personal or business expenditure, and to ensure that you account for all the spends out of that 10 lakh plus cash withdrawals. Ensure that your GST and income tax returns are reconciled one very important reconciliation for specifically the MSME traders is reconciliation with Jyotsna is saying 10 lakh annually. Yes, it is 10 lakh annually withdrawal. So one very important reconciliation is the e-way bill reconciliation, right? So many of the traders, right? Many, I think all the traders, now they purchase intrastate, interstate from big dealers, right? They go and purchase in cash, right? And see Delhi, all the metropolitan cities and all the big cities, I think traders from across India, they go there, they spend money in cash, immediate they purchase in cash, and they ship it, they do a parcel to their hometowns, etc. So mind that the suppliers are generating e-way bills on you as a MSME trader. And you must ensure that all those e-way bills purchases are accounted for, right? So when you have a purchase which is reported by somebody else through an e-way bill, you should have a corresponding sales also. This is a very, very important for the MSME sector from the next tax year 26-27. Right. So this brings us to 31st March 2026 do's and don'ts. Right. So updated return already, CBDT to the restaurants, they have said, please file your updated returns. So for financial year 2020-21, the ITRU is getting time barred on 31st of March 26. Even for the last few years, if you want, if you have certain unreported sales or misreported sales or misreported income, underreported income, which you feel you want to pay off and come clean, then or any of your clients, they wish to come clean, best time now before 31st March, even if you want to say come clean of your underreported income of financial year 23-24, right, or 24-25, then till 31st of March, you would have to pay less additional tax. So for the first year, you have to pay only 25% additional tax. And mind that this 25% is additional tax on tax, right? It is not 25% of the taxable amount. So 25% of the if your tax rate is 30%, so for the first year, you pay only around 7.5% additional tax, and you can report all your underreported income and come clean. Second year, it is 50%. That is 15% of the taxable amount. Third year, 60, and fourth year, 70%. Of course, all of you, many of you are professionals out here. You're dealing with taxpayers. So you always do a reconciliation with the 26AS, AIS, TIS. So please pay your advance tax accordingly so that you save on the interest amount. Buyback. Well, many of the taxpayers, specifically the smaller taxpayers, they make a mistake. They think whatever comes in the budget, it is applicable for this year. It is not that. So buyback taxation, that has been streamlined in this budget. We have already had a budget session. You can go through our YouTube channel. We already had a budget session. We discussed on this buyback taxation. This is changed now, but this is changed only in the new act. That is from tax year 26-27. In case you have a buyback, you see income, then you need to offer it to tax as dividend income for assessment year 26-27. Capital gain harvesting, right? I would not say harvesting per se, while this is the colloquial term, that is why I've used it over here. You can look at your books of accounts and the capital gains which you have had over the last year, financial year 25-26. If you have had a good gain and you have crystallized that gain short term or long term in gold, silver, equity, mutual funds, etc., then this is the right time before 31st March. We all know that stock market is at the lowest. If you want to book your losses also, this is the right time. Don't book it in the fund in April. Better book it now before 31st of March, so that at least your short term and long term capital gains, in case you have anything earlier, that gets knocked off, right? And this is called capital gain or tax harvesting, right? So during a year, you book your losses also, you book your profits also, and so that you pay the tax on the net income, right? And mind that if you have a say you have a 10 lakh rupees short term capital gain earlier, and now due to stock market trumpling, you have a short term capital loss of say 4 lakh rupees. So instead of 2 lakh rupees on 10 lakh earlier, if you book the losses, you would be paying 1,20,000 rupees. Of course, that there is a loss, that is right, but at least you would be saving on 80,000 rupees if you do this kind of capital gain harvesting. But only if you want to kind of book those losses actually. But do not do speculation in this, because that is not allowed, right? Please sell your shares only if you want to, or your capital assets only if you want to book those losses actually. Of course, also, if you have long-term capital gain, you can book those capital gains and get your 1.25 lakh rupees exemption under section 112A on listed equities, etc. So, right time before 31st of March, if you want to book long-term capital gain and get that 1.25 lakh rupees of exemption. So 12.5% on 1.25 lakh rupees, that is uh, around 50, 16, 17,000 rupees. So not a small amount, 17, 18,000 rupees, which you can get the benefit just by being vigilant before 31st of March. Also see your last ITRs, point number 3 on your screen. See your last ITRs. If you have short-term and long-term capital loss, which you have already carried forward for 7 years, then you see uh, you may book a capital gain so that you can utilize those losses, right? Many times, many of the taxpayers, even sometimes consultants, certain times they mistake while calculating the advance tax. They do not take into account the capital gains for the purpose of calculating advance tax. So please take into account capital gains also for the purpose of calculating advance tax, and pay off your advance tax by 31st March if you have not paid it off earlier by 15th of March, so that you save on the interest. Salaried taxpayer, choose your regime carefully. One question which salary taxpayers ask us every year, by and large, sometimes some of them ask us, is that before the employer, if we have opted for certain regime, and while filing the income tax return, we want to opt for a different regime, can we do it? Of course, yes. Whatever option you have chosen before the employer, that is not mandatory. Before filing the income tax return on 31st of July, you can always choose the regime which is most beneficial for you, right? For taxpayers who are going under the old scheme, right? Now, you will see in the new income tax, there is a new form of declaration to the employers. Here, the HRA declaration, if you are getting HRA, then you need to disclose that whether you are related to your landlord to whom you are paying the rent. So we have seen, obtain number of cases where you are taking rent, you are giving rent and taking the house on rent from your parents also sometimes. So please be careful whenever there is a related party transaction, and have a rent agreement, and ensure that the valuation of the rent is correct. For taxpayers under the new regime, this is the first year where you get 12.75 lakh rupees under the head salaries as tax-free exempt salaries. But mind that, ensure that your TDS employee deducts the correct TDS. If at all he has deducted higher TDS, tell him that, gentleman, at least rationalize the TDS in March, and ensure that you file your income tax return if you want to claim this rebate. If you are a taxpayer who is under the old scheme and you want to take the rebate under the old scheme, if your threshold limit of income goes above 2.5 lakh, if you're taxpayer under the new scheme, if your threshold limit of income goes above 4 lakhs, you have to mandatorily file the return. For businesses, 31st March to do, change the TDS or TCS on your SAP, Tally, etc. From 1st of April, when you are making the entries in the Tally, it has to be a completely new TDS, TCS sections which you need to enter. Rohit will take you through the TCS, TGS changes in the new Income Tax Act 2025. Also, some rates have changed, like for scrap, from 1% it has become 2% from 1st of April. So ensure the TCS rate is changed, and other some rate changes are there. MAT, there is completely revamping of MAT from 1st April 2026. So under old regime or new regime, MAT becomes 14% from 15%, but it becomes final tax. No MAT credit will be available going forward, right? And if you are under old regime, you have to book the expenses of all MAT credit carried forward till date. If you are under the new regime, for the next year when you are making your budgets, and you will get only 25% of your tax liability as MAT credit, irrespective of how much MAT credit you have carried forward. So when you are making the budget of taxation, if you are under MAT going forward, please ensure that in your budget in from the next year, you take into the tax expense in your budgets appropriately, because this would be a great hit to businesses who are under the MAT regime. 43BH, all of us know SME payments. So please make the payment to your creditors by 31st of March within 15 days or 45 days, depending upon whether you have an agreement with them or not. Any let out property, so real estate players who are renting out the property, any let out property now you cannot show under PGBP after the amendment made in 2024 Finance Act, right? So if you are, say, multiple companies, in some you have businesses, in some you have just a property which you are letting it out. So in such case, you cannot offer let out property under PGBP. You have to offer it under house property only, and therefore the expenditure for business which you are incurring for letting out, that you cannot claim as a deduction. You can of course claim 30% standard deduction. So TDS, TCS, Rohit will take forward, and of course advance tax you need to pay. For income for house property on 31st March, for those in the real estate business, if you have let out house property, one another deduction which you can take is the interest, right, on home loan, on loan, etc. Plus, if you are into business of selling the properties, etc. So in case you have house property as stock in trade, then maximum up to 2 years you can keep it vacant. Else you have to offer the deemed rent for taxation. So in case you are in real estate business, you have showing house property under stock in trade, ensure that it is not vacant for more than 2 years. Otherwise, from 1st April, you need to offer the deemed rent for taxation. SFT transactions, significant financial transactions. I have already said that 10 lakh rupees per annum of cash withdrawal from the banks, that's a new SFT transaction, and we must take cognizance of that. If we are consulting for our clients, we must create this visibility with our clients and also for our own companies and group companies if you are working as tax or finance professionals. This is a very important development. Otherwise, cash withdrawal from current accounts or deposits in current account more than 50 lakh, that is always an SFT transactions, and other SFT transaction, credit card payment more than 1 lakh rupees by cash or 10 lakh rupees or more, you must have the so much of income. If you are withdrawing from credit cards or if you are spending by credit card more than 10 lakhs of rupees for personal expenditure, ensure that you offer at least 20-25 lakhs for taxation. It should not be that you offer 11 lakh and spend 10 lakh rupees through credit card only. So all these small things we must take into account. And for NRIs, actually, I have a point for NRIs is, many NRIs over the last few years, they have come to us and they don't want to file their taxes returns in India because they feel that unnecessarily they'll get into a fix in their countries. But friends, if you have a TDS of more than 25,000 rupees, many NRIs, they don't want to file their income tax return and claim a refund. But then return filing becomes mandatory. Many NRIs, they do a lot of transaction with their relatives in India. They transfer, bulk amounts in India to their relatives. They withdraw from their relatives. They use their NRO accounts to do huge transactions. They purchase property in India. So all of this as an NRI, if you are doing, ensure you file your returns. Do not avoid filing your returns. So TDS part, Rohit will take forward. So what are the changes as far as transitional provisions are concerned? Friends, I would, tell you one basic thing. You see, you can go through our YouTube channel. We have discussed the transitional provisions in great detail from 1st April 26, which would be applicable in our videos. But one important thing which you must be aware of and you must take note of, be careful of this assessment year 26-27 and tax year 26-27 confusion. For example, I will show you. We just got on your screen. We just got a message from Kotak Bank today morning. You know that now all the challans for income tax payment, etc., that will have a new drop down: assessment year or tax year. Choose your option carefully. So, for example, when you are paying the TDS challan for April till 30th April, you'll pay your TDS challan for the month of March. Choose assessment year. But 7th of May, TDS challan, choose tax year 26-27. Again, when you are making your advance tax payment, choose tax year 26-27 on 15th of June. But on 31st of July, when you are making your self-assessment tax payment for filing your ITR, choose assessment year 26-27. Right? So this assessment year 26-27 versus tax year 26-27, be very careful of. Use the correct forms, right? While filing an appeal for any assessment year before and on 26-27 assessment year, of course, you will not get the orders now. For till assessment year 25-26 as of now, use form 35 to file the appeal, right? Do not use the new form of appeal, right? So today you might say, oh, I will always use. But after 6 months, it will be very, very difficult to, manage this old act and new act, because today you are not that conversant with the new act. After 6 months, 1 year, you will be forced to be conversant with the new act, because that is what the act will be in effect, right? So that time, this assessment year 26-27 versus tax year 26-27, the forms which you use, these all will make a lot of difference. The sections which you use in your computations, etc., it would be very, very important. we have all seen in the past that small mistakes in these at years, etc., that can create litigation going and it can create a lot of hardship. So procedurally, a lot to do in while implementing this new Income Tax Act 2025, right? So, all your rights, privileges, obligations, or liabilities, right? All your options which you have chosen, new regime, old regime, that will continue. All your refunds that will be paid to you under the old regime. Uh, Demands which are under the old regime, they'll continue under the old regime. Penalties under income tax, they see a massive change. Now you will get penalty order, the quantum and penalty orders, both in the same order, right? So that is a new change. You need not make new declarations. Whatever option you have exercised, you have exercised. If you don't want to change your option, no new declaration is required, right? And so on and so forth. One important, again, point number 9 on your screen. Now, if you see section 536 2J of the new Income Tax Act 2025, you will see that in case any circular, it is inconsistent with the provisions of the current act, then that circular will not prevail. So friends, you must be very careful wherever you have taken a position on the basis of a circular. I will give you an example which I have stated not today, but in February 2025. If you see my video on our YouTube channel of February 2025, when the Income Tax Bill 2025 was presented by the Honorable Finance Minister, that time also I had said, even today I am reiterating this 536 2J. So 194R TDS, you do not deduct 194R TDS on post sale discount. Why? Because there is a circular 12 of 2022 which says post sale discount is a benefit or a perquisite, but to prevent hardship, the circular relaxes the TDS under 194R on post-sale discount. Now that circular becomes inconsistent with the current Income Tax Act section 393, which replicates section 194R. Therefore, that circular, in my view, due to this 536 2J, it becomes inconsistent, and therefore from 1st April, you as a tax consultant, you as a taxpayer, you need to take a call whether you need to deduct TDS on post-sale discounts under 194R or not. There are many other positions. If you go through this act section by section, every section, friends, you will find that it will throw upon you new questions which you need to answer. So go through your computation. We from Tax Connect are doing implementation of Income Tax Act 2025 in many companies. Let me tell you, we are completely doing an impact analysis of your last computation, so as to see what are the positions you are taking all your returns, TDS, TCS, income tax return, income tax computations, and we are revalidating those positions, and we are finding that there are certain changes in the positions which you have taken in the past, which you will be taking going forward in the new act. So impact analysis is very important. And of course, all the carry forwards, you need to be aware of MAT credit carried forward, unabsorbed losses, unabsorbed depreciation, carry forward of losses, etc., so that you get the benefit in the new act. So your last ITR becomes very important. Section 143(1). Well, I will discuss with you a case which I argued before the Honorable Income Tax Tribunal. You see, the case was very simple, but how things get complicated when we do not take the right actions. We all have dealt with 143(1) adjustments, right? Uh, and we feel that the only way forward with 143(1) adjustment is to file a rectification under section 154. But what if the government does not rectify under 154? Then what do? You file an appeal. But till then, your 143(1) becomes time barred to file an appeal, and therefore there is a mess. Now, in the instant case which I argued, what happened, the income tax department after 143(1), the taxpayer did not go for filing an appeal against 143(1) adjustment. There was a 143(3) order. Now, in that 143(3) order, which was on that same point, and it was a covered matter, right? There was certain glitch in that 143(1). Now, 143.3, the AO said that I have sanitized the entire document submitted, but I will go with the 143(1) adjustment. CIT appeals, the taxpayer went against the 143.3 order to CIT appeals. Now, CIT appeals has disengaged the case, and it said that because the taxpayer did not appeal against 143(1), therefore it is construed that the taxpayer has accepted the adjustment in 143(1), and therefore it passed the order confirming the demand. Friends, which brings us to the very important point on handling 143(1), right? Is that you must always, in case there is an adjustment, file a 154 rectification, but also file an appeal against 143(1), right? TDS on year-end provisions. Well, a question which is asked, as I discussed in the opening remarks, whether you need to deduct TDS on year-end provisions or not, right? Many provisions we do to show the true and fair view in the books of accounts. Taxpayers ask us, department litigates on this provisions, whether TDS has not been deducted. Under the Honorable Apex Court and also the Honorable Karnataka High Court in the case of Subex Limited, it laid down a cardinal principle for the purpose of TDS on year-end provisions. In case the payee deductee is not identifiable, then no TDS is required to be deducted. If the deductee is identifiable, you need to deduct the TDS on year-end provision. So I have given you a thumb rule, a cardinal rule for TDS on provisions. Employee salary, right? Under the old regime, those employees are there. They need to take into account the income tax, the new income tax rules 2026. There is a drastic change in the perquisite and the taxation. So perquisite, car perquisites, there is a drastic change. I think there would be a tax impact of around 35,000 rupees on car perquisite itself. uh, Enhancement in the some benefits are there, like gift vouchers, meal vouchers, children education allowance, that threshold limit. So all of this you need to take into account while you deduct. If you are an employer, you deduct TDS of your employees. If you are an employee under the old regime, you need to ensure your computation on the basis of which TDS is deducted by your employer, that is correct, and no excess TDS is deducted, or the TDS which is deducted is apt. Some changes in the HRA provisions also we have discussed. Again, you can go through our YouTube channel. Around 1 month back, we have discussed all of these changes to the employee deduction here in the income tax rules 2026. Now, fake invoices, fake expenditure under income tax, right? This is a new trend which is coming in the adjudications and assessments in income tax, right? So in one of the cases, now we will discuss on how to kind of argue these cases, how to defend. Well, friends, I can tell you, many of you are tax consultants over here specifically. You may be, disheartened in the last few years because of these faceless assessments not getting the right orders. Let me tell you, now this faceless regime in the last 1 year, specifically for MSMEs, it has changed drastically, and all your submissions, that is taken into account before passing an order. So in case you have this kind of allegation in your show cause notices that, gentlemen, I have done a 133(6), to your vendor. He has not replied. Therefore, your vendor is not traceable, and therefore he has added your expenditure, saying that this is not a deductible expenditure. Friends, if you have make a payment to these vendors through bank account, if you have the invoices, if a GST e-way bill and all these documents, you submit these documents, and thereafter the onus rests upon the department to prove that these are actually non-deductible or fake expenditure. So this is very, very important. You see, there is this case of E2E supply chain solutions, which was in this, it was held by the Honorable Income Tax Appellate Tribunal in Chennai, that the assessee's primary onus is to provide the evidence, and thereafter the burden shifts on the revenue to make the further inquiries. So, again, under section 69C, the fake expenditure or expenditure can only be challenged if the source is challenged, right? Just because the expenditure is found acceptable, you cannot, as an officer, invoke 69C, right? Uh, if at all, section 37, the add back has to be under section 37 and not under section 69C, that is the unexplained expenditure section. So there are few amendments yesterday, I mean on 20th March, which were moved by the Honorable Finance Minister in the Finance Bill 2026. Very soon it will become the Act. So majorly, because of paucity of time, I'm going a little fast over here. Majorly, the new amendments to the Finance Bill 2026, which will become an act, that is that in the new Income Tax Act, if you have a demand in the new Income Tax Act and a refund in the old, or if you have a refund in the old, demand in the new, those can be set off against each other. If you have to pay an interest, say for example, you are paying self-assessment tax and you are paying interest on self-assessment tax in July 2026. So some part of the interest will be under the old act, some part of the interest will be under the new act, right? So earlier, the understanding under 536 2G was that two different challans are needed. Now they have clarified that only one challan will be needed, right? So this is a welcome clarification in the repeal and provision, repeal and saving section in the Act. So contesting penalties, again, I would take just 2 minutes and, one another matter which we have recently argued in the Income Tax Appellate Tribunal. So, you see, penalty, be very, very careful, right? When you are when you are contesting on penalties, penalty has the sections of penalty and the subsections have to be very strictly invoked, right? Now, if we argued a case wherein the officer, we admitted the client admitted the quantum demand because there was some error in interpretation, and thereafter he got a penalty order under section 270 capital A for underreporting of the income, right? Underreporting of the income. Now, see, this income tax officer, the assessing officer, what he did, he invoked section 270A 2B. Now that 2AB, that clause is for those taxpayers who have not filed their return or filed their return after invocation of section 148 for the first time. This was not our case. And therefore, this was the sole point on which we argued before the tax tribunal. So again, section 271, 274, all penalties. Whenever there is an invocation of the penalty, you must first see, this is our sole submission before this August gathering, that penalty matters, please very minutely see what is the allegation, whether that allegation actually is pertinent to your case or not. Certain other important developments is this LTDS, new low TDS deduction certificate. There is a Delhi High Court case in the case of Make My Trip and so many earlier cases where LTDS applications, they are rejected on grounds which is not as per Rule 28A. Under Rule 28A, when you apply for low TDS deduction certificate, the sole thing which the officer must see is that whether your taxable income and the tax is disproportionate so as to grant you or reject the low TDS deduction certificate. In this Make My Trip case, the officer rejected the low TDS deduction application on the ground that there was a outstanding demand, and that demand was itself being argued by the taxpayer. On these grounds, you cannot reject the low TDS deduction certificate. In the new act, new form is there. Now form 13 is there in the new act. Under form 128, more disclosures are there, which would make the position more clearer. No TDS on reimbursement of expenditure was held by in the case of Pfizer products, right? So reimbursement of expenditure, this is a settled position, but this case was a little different for Pfizer. They did a cross charge between two of the group companies and it was pure reimbursement, and it was held that no TDS should be deducted on these reimbursement in the case of cross charge. So I think that is it from my side. On all these matters, I tried to cover almost all the matters. Rohit will take you through the TDS TCS provisions under the new Income Tax Act and how they will change. Before that, over to you, Pooja, to take the session forward.
Thank you, sir. It was a wonderful session. We get lots of insights, and I have few questions which I think most of the professional or the attendees presented here would like to ask some generic questions, not the specific one. So, sir, my first question is related to the search of restaurants that we have discussed at the very first of this session. Sir, in the cases like these restaurant businesses or the similar section, which are facing the search or survey action, what are the key red flags or the parameter based on which these tax authorities are relies to detect a suppression of income? Sorry, sir, you are on mute, I guess.
Yeah, sorry.
Yeah.
I'm still. Am I audible now? I don't know how I'm getting on to mute. Am I audible?
Sir,
Yes, yes.
audible.
Yeah, yeah. So, I've already discussed this, and as I said, that susceptibility generally what I see is on the B2C business part, from what it comes out of this restaurant search. And most of all, it is that when you are doing the billing, your billing software and your accounts don't match. That is where some sales which are recorded in your billing software, mind that when you record certain sales in your billing software, you think you are erasing all the bills, etc., but it does not get erased. It is there in the intelligence of that software. Somewhere it is recorded, and that is where the problem comes. Therefore, this under billing or under reporting of the billing, I think that is one of the major red flags for B2C trade, number one. And number two, of course, the perennial issue of inflation of the purchase and the expenditure. So these are the two things which the MSME specifically should take care of, specifically when they are in B2C trade.
Okay, sir. Thank you. So my next question is related to this fake business expenses. So how can a taxpayer practically, matlab, being a businessman, how can they distinguish between whether the tax authorities will take it as a genuine expense, this particular expense, or will it take it as an inflated expenses? What are the checks that they should take care of while making such expenses or booking such expenses?
Yeah. So again, what I think many of we should remember what we read in class 11 and 12, right? That is where the basics of this entire thing is there. That is the ratios, right? The taxpayers, generally they come to go to the tax consultants, or generally the finance department closes its books, light at the fag end, and there is not much time for analysis. The income tax department, it has only one tool now, data analytics,
Hmm.
and it will go to see the ratios. What is the percentage increase of expense vis-a-vis last year? That is one. Number two is your TDS, TCS, right? The TDS which you deduct for your on these expenditure, they go on and check by data analytics whether those vendors, they have filed their income tax return and have offered their the incomes for taxation. So number one, you have to be very aware and analytic about what is the increase. There should not be a huge increase, disproportionate increase in your expenditure under heads, number one. And number two, your vendors, your on whom you have deducted TDS, or to whom you have made the payments, they should be genuine vendors. These are the two important things, I think, as a thumb rule, which we must remember in the businesses.
Sir, can we do planning in advance, like before the completion or at the near of the completion of the near to the end of the year? If we plan beforehand, okay, this is going to be my sale, so I have to make sure that I am making payment on gradually basis, not at the year end. So I think we can uh, avoid such things.
Very, very, very good point. In fact, yeah, I missed this out. Uh, do not uh, kind of leave all your expenditure, booking and TDS till March. In fact, what I always propagate from Tax Connect, what we do, we tell people that keep your March returns, TDS returns, and these returns light, so that don't push everything back till March.
Right. So I have one more question related to salary. Like the salary taxation has been changed in the new Income Tax Act 25. So, sir, what are the area which you think can most likely to be litigation hotspot? Like what I have felt in the past year, the people who are claiming refund in the case of salary, their refund has been put on hold for a longer period as compared to earlier years. So what we can expect in the coming year?
No, so refund is one part, but I think more important is those who have claimed deductions. Their refunds have been put on hold. So
Right.
for people in the new regime, I think they have got their refunds. I personally got my refund in one day. I'm sure many of us have faced this. So deductions, political deductions, political donations,
Mhm.
HRA, I think HRA and all these allowances, deductions, this will be a critical thing to see. The income tax department will scrutinize all your deductions now. There are disclosures to even give the LIC policy numbers, etc., etc., and disclose all your investment details. So deductions would be one important thing for all the salary taxpayers.
Okay, sir. Thank you, sir. That's all for the session covered so far.
Thank you.
So I think there are a few questions in the chat box.
Yeah, I think after Rohit completes his deliberations, we'll take it forward, take all the questions. I think Rohit, over to you for taking forward on the new TDS TCS regime in the new act.
Okay.
Thank you, Vivek sir. And thank you for this detailed deliberation on these new income tax changes, which you have discussed in detail. You have also discussed this litigation which has been raised by the Indian income tax law and their practical implications. And I think this audience will be definitely get benefited with this part. I will taking all of you through the TDS and TCS changes, which is under new income tax Act 2025, read with income tax rule 2026. So why TDS is important, that can be understood from this comparison chart, which is just an overview of direct tax collection. If you will see over a period of last 5 years, the TDS component in the whole direct tax collection is by and large equivalent to the advance tax contribution. There is a variation of around 2 to 57%. Otherwise, this contribution of TDS collection is by and large more included in the direct tax collection, except for 23-24, where TDS contribution is only 27.88% of total collection. For other years, we can see at around 40% is the contribution of TDS. So this clearly indicates that yes, TDS provision is also equally important, which is to be taken care of under the new income tax. Now, if you will see, the first release by CBDT regarding this new income tax act is on 8th of September 2025, where they have mentioned that this new income tax act will be repealed from, the old income tax act 1961 will repeal from 1st April 2026, and from that date this new income tax 2025 will come into effect. It is also to be seen that section 397 subsection 3 clause F of this new income tax act, it says that the time limit for correction of the TDS return has been reduced to 2 years, which was earlier 6 years in the previous law. So this major changes which has been came into effect in the new income tax law. So to counter with this and to ensure compliance, the taxpayer or the SSEs need to ensure that the TDS returns filed for the Q4 of financial year 2018-19 to financial year 23-24 third quarter, if any correction is required in these TDS returns, then that correction is to be filed on or before 31st of March 2026. Otherwise, it will be time barred. So this is a very crucial point. In case you feel any rectification is required in TDS return, before it is getting time barred, you should file before 31st March 2026. Another important change in this new income tax law is regarding lower TDS or TCS certificate. If you will see section 395, which is regarding certificate of the new income tax act 2025, it says that if you want to apply for a lower TDS or TCS certificate, you can apply for the same like last year, but there are some critical comparative changes which is to be taken care of while you are making application for this lower TDS or TCS certificate. Now, what are the changes? First changes is this lower TDS and TCS certificate can be applied for any income which was previously for specified type of income like interest, rental income and other income. Now in this new law, any type of income can be claimed for lower TDS. This is a favorable change, we can say. Next change is lower rate application can be applied through the new application under the new law. Previously, the option was there to apply for nil rate also, but this nil rate provision has not been included in this new law. So only lower rate deduction can be applied under the new law. Next is regarding validity of this lower deduction certificate. This validity is maybe 1 year or more, which is as per the rules. Now we'll need to see how this rules are coming to regarding this validity of the certificate. And most importantly, this new law has given power to AO to cancel the certificate during the financial year. So it may be the case that from one of your deductee, you received the certificate for lower deduction. You have started deduction at a lower rate in the between. In case due to some non-compliance by the deductee, the lower deduction certificate has been cancelled. It is very critical that you track this validity of the certificate while filing or deducting the TDS to avoid the risk of lower deduction of tax. So this is a new major change which provide the power to AO to cancel the certificate before its expiry. So this is a very critical change. One more important change has been introduced recently, that in case you have received any lower deduction certificate from one of the deductee, you should monitor the consumption of that certificate. For example, the certificate has been received for 5 lakh rupees, out of which the utilization has been done for 1 lakh rupees in the quarter 1. So only for remaining 3 quarters, only 4 lakh rupees remain unutilized. That utilization can be traced online on the Traces portal. We'll see on the next screen how this utilization is sampled in the next screen. So this consumption statement can be traced. Now we have discussed in previous screen that this cancellation should be traced before using this lower deduction on the basis of lower deduction certificate given by the deductee. It is also need to see that the consumption of this lower deduction certificate will be computed on a FIFO basis. So the deduction will be in the first quarter by any of the deductee will be considered as consumption in the TDS at lower deduction certificate. So in the Traces portal, you need to log in, go to statement option. In history, you can validate lower deduction certificate. The lower deduction certificate consumption can be traced in the Traces portal. This we have taken a screenshot for you for your ready reference. In this screen, you can see that certificate number will appear, financial year, PAN, etc. This will appear, and the certificate limit. This will also appear. Now, amount consumed, it is showing 0. It means the whole value of certificate limit is valid, and this can be used for lower deduction. So this amount consumed and certificate limit is to be compared before deducting TDS at a lower rate on the basis of certificate given by the deductee. We also know and we have heard in recently that yes, the form numbers had been changed. By and large, each and every form has been changed. We can see. So we have listed down some important forms for you, like for application of TAN, form number 135 is there, which was previously 49B. This is for non-government entities. For government entities, there was a separate form has been specified. Regarding TDS returns, new form 138 has been shifted instead of form 24Q, that is for payment to salary. For other than salary payment, the form was previously 26Q, which has been shifted to form 120. For quarterly TDS return for non-resident payment, the new form is 144, which was previously 27Q. And TCS quarterly return filing for other than non-resident, which was 27EQ, is new 143. Further, the application and declaration numbers has also been changed. For lower nil or TDS certificate, the form number was 13, which has been changed to 128. For donation declaration for non-deduction by either by senior citizen or non-senior citizen, the common form is 121, which was separate form was prescribed in previous law with 15G and 15H. A common form 141 has been specified in new income tax law. That is Stalancome statement for property purchase, for rent, for contractor, and for virtual digital asset. For certificate, annual TDS certificate for salary, which we know in the form of Form 16, this will be known as Form 30 in the new income tax law. For the TDS certificate for non-salary payment, which was Form 16A, this will be known as Form number 131 in the new. Form 132 has been specified for TDS certificate for property transaction and rent, which was two different forms in previous law 16C. Crucial changes has been provided in the form and at the time of filing of return, which we have listed 10 critical changes for you. While you will pay the challan or you will fill the return, you will find that these 10 changes has been introduced recently, like auto population of pre-filling of relevant detail. Like when you have created profile in Traces portal, the relevant detail which is available on the profile, that will be auto populated so that there is no mismatch. Real-time validation and error handling will be there. Whatever value you put, the backend system will validate it so that the chances of error will reduce. In most of the field, drop-down had been given so that free field has not been used for a vague entry. Only you can specify the fields from the drop-down option given. Integration with API and database, backend system of the traces will manage the database and they will synchronize with the form so that integration will be there. The data you are feeding and the data checkbox based smart verification has been given. Only need to tick and proceed for filing. Standardization of name and address field. So the name and address will be auto populated from the backend system that is given in the traces profile. And in case you provide the PAN and TAN in the form, the name and address will be auto-filled. To further make the system friendly and enable e-filing, different boxes has been given for name, designation, address, and PAN, which was not there previously. We all know that the assessment year, financial year, and previous year has been done away with in the new law. The tax year will be known to know the current year. So this terminology has been updated in the forms. There are new sections instead of the old section. So this section clauses and schedules has been updated in the forms. Currency symbol has been changed to rupees, which has been notified symbol for the currency. There is no change in salary rate of deduction of TDS on salary, and also TDS on accumulated balance PF will remain 10% like it was there in the previous law. Regarding TDS rate for payment to resident, the 2% rate is there for commission, rent to land and building, rent for plant and machinery, etc. For rent, land and building, it is 10%. For sale of immovable property, it is 1% only. We have prepared a comparative chart in this slide so that you can compare the old section as well as new section. So when you are moving toward the new income tax law, which is going to introduce come into effect from next week only, we must be prepared that in the accounting system and the ERP system, this new section has been incorporated in the new ledgers so that while we pay the tax or we file the return, our reports is being generated in line with the new income tax law. So we have prepared a comparative analysis for new as well as the old tax for the TDS and TCS part. For compulsory acquisition, mutual fund income, business trust income, investment fund income, securitization trust, etc., the TDS rate is still 10%. Interest on securities and bank interest, it will be rates in force will be applicable. For a contractor or individual SUF, it is 1%. For others, it is 2% like the previous regime. For professional fees and director fees, as well as dividend, the rate of TDS is 10%. For technical fees, it is 2%. Like e-commerce payment, virtual digital payment, the rate has been specified in the list. We will share the PPT with you. For your detailed understanding, you can go through at your own pace. For non-resident also, we have listed out the list of TDS. For LTCG, GDR, for foreign investment income, other income, the list has been given so that this list can be used as a ready-made chart for your team so that this TDS rate can be compiled in a consolidated manner. Regarding TCS rate, RAP, mineral, etc. For motor vehicle greater than 10 lakh rupees, it is 1%. For LRS remittance, it is 2%. And educational purposes. For overseas tour and user packaging lot, it is again 2% TCS rate is applicable. So we have seen that under the new income tax law, this changes has been done in the forms as well as the challans so that the process of filing and compliance is streamlined, is easy and user friendly. So now we are ready to welcome next week this new income tax law. We all are ready for this new income tax law. ERP changes is almost implemented. Training has already been completed. We in a Tax Connect done for our clients various trainings, ERP implementation, so that our client will be ready by next week for with the new income tax law. Let's see how this new portal will be introduced over a period of time. By that time, we will be ready for you to help you out at any manner. We are also thanking you Edukating for organizing monthly this seminar, which will be helpful to discussing these critical changes, which will be which will be practically implemented in this new income tax. So this is it from my end for today. Thank you very much.
Thank you, Rohit ji. It is these all sessions are very useful, especially being this is being the transitional phase for Income Tax Act. So I have one practical question related to TDS on rent. So many times what happened that landlord turn out to be non-resident in between the year and tenant get the information at the end of the year. So by that time, the tenant must have been deducted the TDS under section 194 1B in the as per the old Income Tax Act. So now as the landlord has turned out to be non-resident, so section 1 from where the section 195 will applied retrospectively or prospectively, and how these situations should be handled by the tenant.
So in this case, what I understood, from the day one, the landlord is the non-resident.
Landlord was resident initially, and during the year it turned out to be non-resident.
Actually, what has happened, say till June, he was not resident. From
Yeah.
July, he became non-resident.
Right, right. Sir.
So Vivek sir, if you want to take this question, please.
Yeah, actually, this is a very good, but and practically it can happen. Or say from October, he becomes non-resident. He stays outside India for more than 182 days.
Right. Sir.
Now, see, you are right. Section 195 should be applicable from October. Okay. But you get to know only in March. Now, our advice is, see, the best thing to do, I'm telling you the best case scenario, is you have to revise all your TDS returns, your Q3 TDS returns, right? And if at all you have any other TDS, you can adjust the 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 TDS which you have already paid, and you have to file a new that TDS return and challan return for the NRIs. But interest will be applicable in that case, where actually here no interest should be applicable. You have already paid the TDS earlier, interest may be applicable only to the extent of higher amount of TDS, right? So practically what we would suggest are two things. Your Q4, whatever TDS return is left, to that extent you do the amendment and you file it, deduct the TDS under 195 for at the rate of 30% or whatever the rate might be, and pay the taxes and file your returns. Earlier returns, no need of doing anything. Now there is a section 201(1), right? In the 61 Act, same has been replicated, I think, in section 395, right? 395 or something of that new section, I'm not remembering. So there you take a declaration from the NRI that he has offered the entire income for taxation, right? So you would not be considered to be an assessee in default for that part of the income on which lower TDS has been deducted. This, I would say, in our view, may be a more practical solution. Rohit, you can add on, I mean, in case.
Yes, sir. Like department may dispute that what is the evidence that for initial period the person was resident and later on it was converted into non-resident. So this declaration to prove at any point of time to reduce to counter the case in case of any query from the government authorities.
Yeah, correct. Very important point. Now Rohit is saying ulta. Now you are saying he has become a non-resident in October. So department may say no, ये तो April से ही non-resident था. So you should have the evidence that yes, he has become non-resident only from October and not from April.
Yeah, it is very important point to take the declaration from the landlord in that case. If there are chances, if we are seeing that there are chances that the residential status is going to be changed for this particular person. I really appreciate, sir. It's a very great discussion we had today, and now we can.
I think there are some questions we should take on the chat box, Pooja.
Yes, sir. Yeah.
Okay, I will start from Mr. Srinivas Rao. Now, from the very beginning, I am starting. Mr. Rao says, remember that TDS, that electricity consumption can't be based for arriving at output manufacture. Honorable Supreme Court case law is there in favor of the SSC. Yes, Mr. Rao, I think Supreme Court, I remember there is a income tax appellate tribunal coordinate benches decisions which are there where it was held accordingly. You are right. But these are old decisions. If you remember, during central excise times, the electricity consumption was required to be given. So this would be the start of a search or a scrutiny, the electricity consumption data. It would have to be corroborated with other incrementing evidences. That is right. The onus is on the revenue. But if there is a huge disproportion, then I think that the revenue with some incrementing evidence, they will give a difficult time to the taxpayers. So that is why, one few mining companies, they came to me and there we saw that there is a huge disproportion. So if that is the level of the disproportion, we must have our explanations ready. So Jyotsna says 10 lakh annually. We have
that is answered.
Explained.
Yes.
Okay. Next. Okay. Shubham says exemption related to allowances enhancement. But this exemption is not available in the new regime. Whether our government wants to push the old regime. This is a question when the draft rules have come. This was asked that what is happening. On the one hand, they want to push the new regime, and here they are increasing the allowances. Actually, these exemption for allowances, increase, relaxation is inflationary in many of the cases like meal coupons, children education allowances, etc. But yes, for HRA, etc., we feel that the government wishes that for the people who have high income, high salaries, even the old regime should continue and the new regime should not be forced on to everybody. Ms. Jyotsna is again saying small businesses are showing GST sales, for example, 9 lakh and GST purchases showing at income tax portal 11 lakhs. Then how to file ITR under 44 AD? Why should you file ITR under 44 AD? You should file ITR under the normal provisions because you have a loss of 2 lakh rupees. See, Ms. Jyotsna, the crux point which she wants to say in my view is that whether these purchases are inflated. I am saying if the purchases are genuine, it may be a genuine case where you are suffering losses in your business. In such case, you must actually claim those losses and carry it forward in the next year rather than taking a 44 AD route. Government would be very happy if you are suffering losses and you are paying taxes by choosing presumptive taxation under 44 AD. So Mr. Shonik says whether children education allowance, hostel allowances are in new regime, old regime or both. It is under the old regime only, not under the new regime. Mr. Venkatesh says how frequently changes have to be tracked ideally with respect to low TDS deduction certificate. Rohit, you may want to take this.
Yes, sir.
How frequently changes have to be tracked ideally with respect to low TDS deduction certificate, whether it is active or cancelled.
Whenever whenever you credit or pay against any transaction, when the liability to deduct TDS arises, at that time TDS is the certificate validity is to be checked so that the correct deduction can be ensured, as per my understanding.
Right. I concur. Mr. Dhrubojyoti says, can you tell me whether all types of pension received by senior citizen liable to tax under 1010D? Pensions, as far as I remember, there is another 1010A, where if you are commuting the pension as a government or non-government employee, for non-government employees, I think a part of the pension, commuted pension, that would be exempt subject to how much of gratuity you are receiving. Maybe you can go through section 10, subsection 10A, Mr. Bandopadhyay. Mr. Jairam Raju is asking Rohit, after remitting TDS under 194IA in the IT portal, is it mandatory to issue Form 16B? I think yes. Rohit.
Yes, it is mandatory within 15 days from the due date of filing 26 QB. Otherwise, late fee of ₹100 per day will be levied. So to avoid this late fee, this Form 16B is mandatory.
Yeah. Mr. Akash says, can you explain all the changes under head salary in Income Tax Act rules compared to old Act? I think Miss Pooja is here from Edukating. She will hold a workshop very soon, a course on the new Income Tax Act 2025, right? And we will take you through not only salaries, but even on all the heads of income and all the new changes in the income tax headwise.
Soon with sir only, we are going to launch this course, a short course only for professional, where we will talk about the changes only.
Yeah. So Ms. Jyotsna is saying 194J threshold 30K or 50K. I think it has been increased to 50K, 50,000 per annum. Mr. Sachin says, can we take a declaration from non-resident about residential status? This is what Rohit was saying. Yeah, Mr. Sachin, you should take.
You should take.
If Mr. Rajkumar says if a invoice dated 31st of March 26 from a vendor, we have received the same in 30th of April 2026, then whether old or new section is applicable. Rohit, you may want to take this.
Yes, sir. So as we know that TDS is get attracted on the date of payment or credit, whichever is earlier. So if you are recording this transaction in 31st March, we understand from your query that invoice date issued by the vendor is 31st March, but you have recorded in your books of accounts in the month of April 2026. So provision of new law will get attracted and not the new law, not the old law.
Yeah. Next is free meals or meal vouchers exemption allowed for old or new regime. I think old regime only. Shubham says salaried person paying rent to non-resident individuals. Rohit, this is on TDS under 195. So
Yes.
maybe you can take it. A salaried person paying rent to non-resident individual. He needs to require the TAN and file it quarterly. Yes, I think. Case 1, less than 50,000 per month. That is the case, and case 2, more than 50,000 per month. To be TDS to be deducted under 195 or not?
Yes. So TDS under section 195 is required. However, rates in force need to check. But like in the query, he has mentioned that he is paying rent to non-resident individual. So yes, the need to require the TAN and file the return accordingly, and TDS is to be deducted under 195. So answer is yes.
Right. Ms. Jyotsna says sales are generally underreported to save GST. That's why many businesses IT portal showing like this. Medical shop, jewelry, it's hard to digest the loss. Ms. Jyotsna, I think you see underreporting of turnover, that is not the solution. The businesses have to have the right model so that they can legally sustain. And I think as a consultant, you must advise all your businesses and all your clients to disclose their correct turnover. Are my pending litigations or refunds under 61 Act active? Yes, they are still active. Right. So I think we have answered all the questions, queries. Pooja, over to you.
One more question came from Mr. Manoj. Surcharge and ECES still applicable in new income tax act?
Yeah, same. It is applicable in the same way it was applicable in 1961 Act.
Because there are no changes in the tax rate so far. Yes. So I must say it was a very wonderful session, sir. We got lots of insights specifically with related to the provision of TDS, as because the assessment and other things will rise after the completion of this financial year or tax year 26-27. But we have to take care of the TDS from the first day of the upcoming tax year 26-27. So everyone is also appreciating this session. I hope all of us have get lots of insights and practical insights that we can use in our professional life, and we can guide our clients accordingly. Thank you so much, sir, for your time and your knowledge sharing with all of us. And thank you, Rohit ji.
Thank you, Pooja. Thank you, Rohit. And thank you to Team Tax Connect for getting this symposium, this fourth symposium on again. Over to you, Mani.
Thank you, Vivek sir and Rohit sir, for this wonderful deliberation. Thank you, Pooja ma'am, for coordinating the session with us. I would extend my thanks to all the participants for attending this webinar. Such webinars are conducted every month, and we hope to see you in the upcoming webinars as well. We will shortly share PPT and video link to all the participants. And we all thank you once again. And with this, we end our today's session.
Thank you.
Thank you.
Thank you, everyone.